As of Friday, less than 2 years after Silicon Valley Bank ironically posted to their website an $11.2 billion 5-year plan expanding commitments to small businesses and increasing access to the innovation economy and investing underserved communities, SBV became the largest bank to fail since the 2008 financial crisis. A bank which provided banking services to nearly half of the country's venture capital-backed technology and life sciences community and companies. And as you might imagine, the bank's collapse has sent shockwaves throughout the tech industry, throughout Wall Street, throughout Washington, throughout the country. We're all talking about this today and what the impact is going to be on all of us. So how exactly did this happen? Well, flush with cash from startups, Silicon Valley Bank invested most of its deposits into long-term debt like treasury bonds, and their expectation was that it would be a steady and modest return. However, the bank's short-sightedness and their failure to consider the broader economic landscape, which was really now overheated from pandemic stimulus, really led to its swift downfall. Silicon Valley Bank found themselves in a precarious position when the Federal Reserve began actually increasing the interest rates in order to fight against inflation, rapid inflation. And as a result, previously secure investments lost their allure in comparison to the new and more profitable government bonds. And this turn of events caused further complications for the bank as startup funding began to dwindle. This decline in funding led to Silicon Valley Bank's clients withdrawing their money. And in order to fulfill these requests, the bank was forced to sell some of their investments at steep discounts, ultimately leading to the trouble that they're in. Following the announcement of Silicon Valley's significant loss last Wednesday, a frenzy broke out in the tech industry with startups hastily withdrawing their money. And last week, the Federal Deposit Insurance Corporation, which we all know as the FDIC, took over Silicon Valley Bank after the institution's financial advisors failed to secure a buyer following a run on the bank. And this move put about $175 billion of customer deposits under the federal regulator, the authority of the federal regulator. And the collapse of this 40-year Santa Clara bank is the biggest since the 2008 financial crisis, and that's caused bigger concerns about similar institutions. While Silicon Valley Bank's assets of about $209 billion don't compare to those of the country's largest banks like JP Morgan Chase, which has about $3 trillion, experts thought that the bank's failure might still spark a panic among customers nationwide of other banks. And that type of a scenario emphasizes the significance of Dodd-Frank, which is financial regulations, and that, some experts say, could have mitigated the bank's risks had it not been rolled back in 2018. On Sunday, yesterday, the Biden administration actually took extraordinary action to restore confidence in the banking system nationwide in order to prevent banking contagion. And that's basically the spread of financial troubles or risks from one institution or market to another. And this can happen when major financial institutions experience difficulties and then other institutions and markets are affected as well. For example, think about it from the Lehman Brothers standpoint back in 2008. It triggered a global financial crisis that led to the failure of many other financial institutions and really caused widespread economic turmoil. Therefore, banking contagion is a serious concern for regulators as well as policymakers. And by guaranteeing that customers of the failed Silicon Valley Bank and Signature Bank would have access to all their money starting today, Monday, they reduce the risk of that happening. Now, the FDIC will make customers whole, even for the uninsured deposits, in order to prevent more bank runs and to help companies that deposited large amounts of money with the bank continue to make their payroll and obviously fund their daily operations. The regulators also stated that U.S. taxpayers are not going to be on the hook for either facility, but shareholders and holders of the unsecured corporate bonds will not be protected by the regulators' plan at this point. The Fed also launched its new bank term funding program, and this is to help prevent the next SVB from collapsing. American regulators have worked throughout the weekend on this substantive plan after SVB's stunning and rapid collapse late last week. We're going to continue to keep you posted on this incredible story as it unfolds and what the impact is across the banking industry. Obviously, look to my previous video related to this story and how you can protect yourself from any type of bank collapsing or malfunction. Systemically, this is a major, major problem. It shines a lot of light on where we're at, and something must be done. What do you think? Do you think that by making this 25 some odd billion dollar bailout that the government is simply kicking the can down the road economically? Where do you think this is heading? Let's make some predictions together. Until I see you on the next video, make it a great day today and keep on cash flowing.